Hey, good morning or good afternoon, everybody, depending on where you are. It's still morning here in beautiful Kansas with the fall weather creeping up on us after I don't want to say a hot summer given the weather we have out west. It wouldn't be right, but it's pleasant here. So this week we set up initially as a opportunity to conduct questions and answers. There were no burning urgent questions submitted, so I'm going to go with the tentative plan of reviewing some of the work that we've been doing lately in our sniper trading workshop and in our Creativity 202 workshop. These are some of our best work lately, and I wanted to just share where we were on that and give you some news that you can use. So the first one that I want to talk about is from this weekend's Creativity 202 lesson. We are on lesson number 17 of 30, so we're on 17 of 30. And it's a long course. We have it programmed for about 32 weeks, and we're doing one deliberate lesson a week, which consists of first reading a short essay from Professor Angus Fletcher, which examines the use of literature to develop creativity in our head. And when I say developing the creativity, what I really mean is using literature to open the door to unleash the creativity that is already innate in ourselves as humans, as primates, whose evolutionary brain was built on the power of storytelling and creativity to solve problems. We had a lot of problems in evolution. We were a primate on the plains of Africa that was smaller, slower than the predators, and we had to use our creativity and solidarity and our opposable thumbs and our curious ability to imagine future states for possibilities. And you put all those things together in a tribal environment that uses storytelling to communicate wisdom from generation to generation, and it turns out that you have an evolutionary advantage that persists to this day. So there's something about our natural innate creativity and storytelling that should want to leverage in our important pursuits in the world, like in trading. So Angus Fletcher, the professor from Ohio State, who's one of the leading researchers in this area in the world, he's the preeminent researcher of story science, has been partnering with me at the Army College where I teach. We're trying to figure out how to bring his research into the hearts and minds of our senior leaders. And we just completed a large year-long research project involving many hundreds of students and under rigorous testing conditions. And we've discovered, in fact, what we were kind of expecting, and that is that the power of storytelling and creativity is very useful for military officers as it is for all of the other populations that Fletcher has studied. He studied fourth graders, doctors, entrepreneurs, business executives, engineers, lawyers. So far, everybody has responded in an impressive way to the Fletcher treatment for creativity. It's a series of techniques that can be taught in the classroom that, again, open the door and tap into our natural creativity and storytelling. Once I saw the power of his technique, I asked him to write a handbook for Army officers to use, because he had about a 350-page best-selling book called Wonderworks that was marvelous. But that's a lot of reading for us to do, and we'd like things that are direct and to the point. So over a weekend, he wrote what has turned out to be his next bestseller, A Field Guide to Creativity for Army Leaders, and it consists of 30 short essays with a couple experiential learning exercises that are intended to try on storytelling and try on different techniques of unleashing our creativity. And it's working beautifully in our college. Well, what I did was consult with him, and I wrote a series of 30 supplemental lessons that pairs one for one with each of his literature-based exercises. So our Creativity 202 course consists of first a short introduction to his theory and research, and then a series of 30 lessons that you take a Fletcher essay and you perform the experiential learning exercises, and then you reflect on it to see how it resonates with your own lived experience. And then we do a set of exercises that I provide that are traders' exercises, and then we reflect on those exercises and what they mean in our trading practice. And then what we do is we come together for about 90 minutes to 2 hours once a week in a small story circle. And in that story circle, we go through a standard process of true storytelling. Now, true storytelling is also related to literature. It was developed by my doctoral mentor, David Boji, and the good people at the True Storytelling Institute. And what true storytelling does is allows us to come together from whatever direction we have been living, and we come together into a safe, trusted, truthful place where we can begin to tell the truth about the reflections and our experiences with the material from the course, and then we share that in a safe way, and we end up building a community of practice that leads inevitably to opportunity in the world. And from these true storytelling circles, we have generated a tremendous number of insights that help us with our own personal trading practice. It's allowed us to learn to collaborate effectively and quickly with each other, and to build multifunctional teams that give depth and breadth to our own personal experiences. It helps us deal with the natural problem of trading being a lonely enterprise. And in this way, we're actually able to bring together three bodies of knowledge. We have the story science of Angus Fletcher. We have my trading and framing experience. And then we bring together the true storytelling circle to help us collaborate. And out of that intersection of three bodies of knowledge, we come up with some pretty amazing insights. So just briefly, I wanted to talk about the session we did this weekend. On the Fletcher exercise, we were learning about the process of inventing backwards and then forwards. And in that case, what you do is you find a historical example of some clever solution, and then you work backwards to the process that was used to generate that strategy. And you say, how did that inventor come up with such a crazy idea? So you don't just look at the content of their solution, because maybe that doesn't apply, but the process that they used to unleash their creativity and then to persuade their team to do it becomes something that we can learn by analogy into our own situation. And then by taking that creative process, we learn to adapt it from the historical case over to our situation. So that is a case of reverse engineering back to the process and then building forward into the application of the new situation. Well, what the particular case was the Trojan horse technique. Well, when you go into the history of the Trojan horse, it turns out that Odysseus didn't really invent that himself. He actually went back into the history of Africa, and there were some clever guys in Africa that used a similar idea where he hid 100 trained warriors into 100 baskets and then gave those as a gift. And then overnight, those guys stepped out of the baskets, opened the gates, and won the battle. Well, Odysseus used that in a different form to come up with the idea of the Trojan horse. So this is a case where Fletcher asks us to live the experience of the people in that story. And then in his two different exercises, he asked us to try on that technique in our own situation, one where we had done something like it and one where we might do something like it, and learn to use the power of our own history and of our own imagination to come up with a new idea. So that's the Fletcher exercise that's embedded in Lesson 17, inventing backwards and then forwards. So then the second part of this exercise is we come over into my trading exercise, and what I began to explore was the feelings that we might associate with this little picture. And so this is a picture of a chimpanzee that I sponsor, and her name is Celia. And what I asked our traders to do was to just look at that picture and help me understand my own feelings. And I had a number of different feelings, and I asked them to do an inventory of the feelings that come out of that picture and ask them, where do those feelings come from, and how does it resonate with stories from your past, and what are some calls to action that your feelings make you want to do. And we saw the range of feelings, like one of inquisitiveness, calmness, community, care and comfort, a certain calm. And this was important because one of the things that we also use the chimpanzee for is as a model of our inner trader. That we know that chimpanzees are very environmentally savvy and very attuned to the world around them. And so when the ecosystem sends little stimuli to the chimp, what can happen? Well, the chimp can run away in fear, they can become enraged. And so what we wanted to say was, we wanted to model our inner trader as a very calm chimpanzee that would give us an early warning to these kinds of triggers. And then when the chimp gives us the early warning, her job is done. So how can we protect her and let our trading parts take care of the signal, and then use that early alert of the signal to trigger us into action that is effective? How can we learn to leverage the power of our inner chimp instead of trying to control the chimp or discipline the chimp or suppress the chimp? Why don't we use the chimp for what she's best at, and that is giving us encouragement and motivation and situational awareness, and then protect the chimp with the way that we are using those signals and putting them into action. So the experiential learning exercise of this effort was to trace the idea of the feelings. And where do the feelings come from? Did the feeling come from the piece of art, or was that something that the individual, with whatever state of mind that you are in, some state of mind, did the state of mind cause you to look at this and then feel a certain way? Is there something we can do about managing our internal state so that when we get stimuli from the world, that we can learn to act in a way that is preferred and professional instead of something that is impulsive? And we began to map the process by which our impulses and our sense-making and our reactions lead into particular actions. And it is in this area that we begin to discover things like how to build processes that leverage our discipline, how can we learn to structure our learning environment so that we act in a sensible, preferred, planned way. And that's really what the essence of trading is all about, that the environment is giving you all kinds of signals all the time, and that we can establish certain filters and triggers for action that then lead to the kinds of actions that we want. And so how can we take a look at this entire process and become intentional in the way that we trade? So we took a look at the reverse engineering that came out of the Fletcher exercise and used that as a way to explore how we decide to go from impulse into action. And if we can map that process, we can improve that process. Now, the experiential learning exercise that we went through in true storytelling was as follows. I told the story of my 5-year-old soccer team from Saturday. And what I do at halftime on the soccer field, after they get their water, is that they all come running over to the middle where we put a little team huddle together. And I kneel down so that I'm at their height. And I ask them, do you have a plan? Does anybody have a plan? And it turns out that they all have a plan because they know that I'm going to ask them. And so I asked 5-year-old Cooper, hey, Cooper, what's your plan for soccer in the second half? And he says very carefully and to everybody in the circle, my plan is that we should guard our goal, and then we should get the ball, and then we should go to the goal, and then we could shoot and score. And then I asked the kids, is that a good plan? And it turns out that they all think that's a pretty good plan. And then I go to JD. Now, JD is a special kid for us. He's very young, and he's not very verbal. He's just learning to make sense of the world and to put it into words. And in fact, for the first 6 weeks of our season, JD was too shy to even give me eye contact, much less speak to me. But lately, he's come out of his shell, and he's learned to trust me, and he comes over and makes eye contact, and he thanks me for practice. And I asked JD, do you have a plan? And JD had a plan. JD's plan was, first we should get the ball, and then we should shoot and score. Now, he has a 2-part plan. And I want you to notice that he's using exactly the same language that Cooper did. It's not an accident that he has internalized and that Cooper has internalized and that the whole team has internalized the minimum viable plan that we need to be successful on. So if we take that plan and then we're well prepared, so if we plan and then are well prepared, it turns out that we can execute that plan very, very well. And so what we do is we choose our words wisely, and then through reinforcement and spaced repetition, we've analyzed our game-winning process. Those 4 things: go to goal, get the ball, guard our goal, get the ball, go to goal, shoot and score. And through constant repetition, they have now made that story their own. Well, it turns out that if you start teaching kids at age 5 those essential elements, it turns out that by the time they're 25, you'll know what it was like to be me on Saturday, because the team on the other side of the ball was being taught and coached by my captain, Natalie. Now, Natalie's been playing with me from the time she was 5, and she still plays on our adult league team. And all along the way, we have learned how to use the power of words and stories and repetition to create a safe, trusted, truthful environment in which we learn how to play soccer well together and to have fun doing it and to play with skill. And so this Saturday was the circle was complete, that Natalie, who'd started out at age 5, had gone all the way around the horn to where she had played as a state-level athlete in high school, got a scholarship and played for 4 years in college, has come back to our community to be a early youth education teacher, and is helping me coach our young kids. So that straight line process has now come all the way around through true storytelling, and then we're starting the next cycle, and we do that with all of our players. So we build out an ecosystem whereby we can use the power of true storytelling to create safe spaces, trusted spaces with trusted teammates, telling the truth in the stories that make sense to us, and that leads to opportunities. So that was the lesson 17 that we experienced this week with the Fletcher exercise, my exercise, and then the true storytelling. So what we did in our 90-minute session, which grew to be 2 hours because people had stories to tell, is that we get into this true storytelling circle, and I'm one of the people, but everybody that was in that circle who had studied both parts of that lesson and done the reflection journals, and they brought with them a story to tell that resonated with them. And we go around the horn exchanging stories. And what turns out to be so amazing is how many different powerful responses there were to that story. And as a result, we all bring one powerful story to the circle, and we get to listen to half a dozen other stories on that same topic. And you come away so enriched with a much deeper understanding of the lesson that you can't even predict how much you're going to learn. All you know is that week after week we keep building on that success. So what I wanted to share in this first part of the briefing is the power of creativity, storytelling, and collaboration to combine to create robust processes that allow us to adapt and then survive and then thrive in the marketplace. And that's what we're learning in our Creativity 202 course. And what pairs nicely with that is the Foundations of Trading course, in which all of the technical elements that we need to take the opportunities that come out of our stories, we can dip into Foundations to find strategies and tactics that are personally useful to all of our traders. And then we have a collaborative space with accountability partners that help us personalize each and every one of those stories. So that's what I want to say about Creativity 202 and true storytelling. And this is just a summary of the way we run that. We start with the principles of safety, trust, then truth, and then that leads to opportunities. While we're in that sacred space, what we're doing is really telling stories that are powerfully moving for us, and we go through a process whereby we recognize that we are in that sacred space. And in that sacred space, when we're telling stories, we're not judging, critiquing, advising, challenging anything. We're simply there to listen and resonate and then offer our story. And then when we leave the sacred story space, it turns out that there's plenty of time to do things, whether it's like workshops or build tools or collaborate together for other opportunities. But when we're in that sacred story space, we really are able to operate at a deep level with deep personal significance. So what I want to do is shift gears quickly, if I may, and take you through something that we call sniper trading. And this is something that has come out of the Creativity 202 course. What we did was we found some people that were trading in a particular way, and they were modeling the behaviors of snipers. And so what we do in sniper trading is that we have a very specific set of criteria that we judge, and that gives us targets. And what we're looking for in sniper trading are targets that are in a compound critical state. And that has a very special meaning for us, compound critical state. And we define a critical state as a situation, let's call it a doji, in which this is at a small compressed range, and it is equally likely for it to make large directional moves in either direction, in which we do not have a bias about what direction it could go. In fact, if this thing breaks out and goes this way, we're ready to go long. And if it begins to break out below that boundary, we're ready to go short. What we know is that the move that it makes out of that critical state is likely to be large compared to the size of what we call the yellow zone. The yellow zone is that space between the mechanical entry and the mechanical exit. So if it turns out that the unit of risk is small compared to the expected reasonable move in either direction, we can frame that in a favorable reward to risk ratio. What we have is a critical state. Now what we do is we take and add to this the idea of the compound critical state. So what we want to do is have 3 or 5 different reasons why this thing is poised to make these large moves in either direction in a short period of time. And from that idea, we developed the sniper trading technique. And this all comes about from the Creativity 202 course, in which we developed the idea based on some questions. How could we create a minimum viable product for trading in multiple time frames? And from that came the idea of the sniper. The sniper. And we built out some tools, and we created a workshop, and then we are turning this into actual live trading on a daily basis. And we got about 6 months of experience with it, more than 400 daily trades, and we are well satisfied with the results that we're getting from sniper trading. So let me show you the ideas that came out, the next level of implementation. So we think that there are two reasons that lead to compound critical states. A symbol could be in a critical state on the basis of location or on the basis of volatility. Now, I can't give you the whole workshop in 3 minutes to any level of detail, but what I can say is that we take a look at 3 different look-back periods: 10 days, 30 days, and 150 days. And we think each one of these represents a population. Let's call it a bucket. Inside that bucket are people who are short-term swing traders that have a 10-day time horizon, medium-term swing traders that maybe have a 30-day time horizon, and maybe long-term buy and hold or position traders that have a 150-day time horizon. And we think that when the price moves to an extreme during that look-back period, that each of those different sets of traders are more likely to think that they are in abnormal conditions. And we think there's 3 of them. That if you're in the top 10% or the bottom 10%, you're clearly overbought or oversold, and so a large move of continuation or collapse would not be surprising. By the same token, we also think that if you are precisely in the middle of that trading range, that you wouldn't be surprised if it went to the extremes of either up or down. So if we can have a minimum manageable risk box, which we call the MMRB, minimum manageable risk box, it may be that we could frame a 3-to-1 trade to the oversold and a 3-to-1 trade to the overbought out of things that are sitting on the fence right in the middle. So we actually recognize 3 different locations in which we're entitled to believe that a big move out of that location would not be surprising. So now what we do is pieces of analysis. We look at symbols that are in a critical state on a long term, a midterm, and a short term. So if we have something that is in a critical state on all 3 of those, we have 3 reasons to believe that there's a large group of people that are ready to pile on. Now, if you're the kind of trader that only looks at your time frame and you see a thing start moving, all of a sudden it really goes hard and you don't understand why, it may simply be that these longer term time frames saw a critical state and then they started adding their money, and that catches you by surprise. So by looking at a multiple time frame analysis, which we call multi-time frame analysis, we can actually find a compound critical state just on the basis of location. Well, that's not the only factor we think that leads to large moves from a critical state in either direction. We also think that short-term volatility leads to those kinds of surprise moves also. So what we know is that the longer that you look back, the less important volatility is. But the closer you get to price, the more important volatility becomes, because it represents abnormal emotional states. So what we look at is a 1-day volatility and a 5-day volatility. And we reason in the following way, that abnormal volatility leads to large moves. So if something is the quietest quiet you ever saw, and you think that's normal, suddenly price explodes out of there. The very fact that the one-day volatility was so small leads to a period of surprise in the subsequent move. But if the previous move was large, like you had the largest day of the last 30 days, and you had this enormous range, well, we already know that it's in play, that there's abnormal size movement, so it would not be a surprise if that abnormal move continued or it reversed in a large way. That is something that's in play. So we look for abnormal volatility in two places. We're looking for things that were very, very quiet or very, very large. How do we do that? Well, we take a look at the look-back period, and we find the average, and then plus or minus one standard deviation, and we just call that normal. We're looking for things that were abnormally volatile already on the volatile side, or abnormally quiet, the lack of volatility, and from those two abnormal conditions, you are more likely to see large surprise moves. So if you put both of those things together, you can now develop symbols that are in a compound critical state on the basis of both location and volatility. That is the essence of sniper trading. So without going into our table too much, what we do is we've identified some standard patterns that look at combinations of different readings for location and volatility. And we have some criteria, mechanical criteria, that we use to identify short-term candidates that are likely to make those kinds of moves. On Friday, in our published report on the Sniper Report, we took our favorite pattern, which is Godzilla, King of the Monsters, and in the S&P 500, we found 30-plus symbols that were in an extreme oversold condition on the long-term, short-term, and long-term, mid-term, and short-term, and had either abnormal large volatility on the 5-day and the 1-day, or abnormal quiet volatility on both 5 or 1. And then we found a bunch of symbols that had abnormally quiet on 5 days and abnormally volatile already on 1 day. And each of those now sets up into a potential move that is large. And what we got today was a large move. And we don't know which direction. We actually don't care which direction. If you're an options player, our workshop will show you how to frame those with breakouts and straddles. But if you're an intraday trader or a swing trader, we show you how to get started well intraday and then let you grow that into a swing trade. That's what we call hybrid trading, and that's in the Foundations course. And then in the short term, the reduced tactical portfolio, which is about 50 or 60 symbols that we specialize in. Like these are the S&P 500 stocks. The tactical symbol set is a combination of ETFs, indexes, and individual companies and sectors that we specialize in. And so we found a lot of things that were long-term quiet and then abnormally large intraday. And so we can use that to help focus our trading. Well, it turns out that those were really powerful moves. What I want to show you is a couple quick examples of exactly that. This is the one from last Thursday, in which on 3-minute charts intraday with symbol SPY, we noticed that the market closed here, and then there was a large gap down, and then we identified the opening range 5, and this is the range that it from the high to the low in the first 5 minutes, and then it broke out from that. And what we did was put our standard risk box, the minimum manageable risk box, which we compute from statistics, to say what's the minimum we use statistics to compute a minimum manageable risk box. So an MMRB turns out to be the size of the risk that we can take, so that if we go long and it starts to reverse against us, that we can take an exit signal here and we can escape with nothing greater than a 1R loss. We never want to take anything larger than 1R. And if we can do that for 30, 50, 100 trades, then we have reasons to believe that we can actually use this as a planning tool. So we know that the size of our MMRB and the SPY was that unit of risk. And we saw our opening and we realized that it would not be unusual to see that gap be closed. And so we saw that there was a 3-to-1 reward to risk ratio, and that met all our criteria. So we took the entry and we placed a stop in our usual place below the swing low. And our first job is that if this thing starts to go up, our job is to get our risk from the 1R loss into what we call a no lose plus dinner for two. No lose plus dinner for two means that we're plus $100 in the symbol. So if this thing turns against us and it hits our no lose plus dinner for two stop, then psychologically we don't mind, because we made $100 and we can take our spouse to dinner in the state of Kansas. And then everything after this is simply a science project. And we adopt the mindset of a laboratory scientist who just wonders, I wonder how far that's going to go before it hits my managed stop. So we go through a series of procedures to simply manage the risk as this starts going up, so that we never take more than an acceptable give back. And then we come out of that with the answer to the question, how much is the market going to give us? We can be disinterested and non-emotional about this. We have protected our little chimpanzee against outrageous misfortune. So we want to turn this into a standard piece of work all the time. Now, here's what that trade ended up unfolding as. It starts moving in our favor. You can see the yellow risk box. We get to a standard exit. So we use various indicators and tools to help us manage this trade in a professional manner. And you can see that we're using a form of the parabolic stop and reverse. We have a refinement in which we, instead of using just price action, we use a different set of price proxy, the 10-period regression line, to compute the PSAR. And we use a form of short-term Bollinger Band. So as this starts going up, we call them the dragon. We get standard exit signals that after the run is done, we take our exit, and you can see that we converted that into about a plus 2R win. Now there's still room to go, so we're ready to re-enter if it breaks out to higher. And we might be, under certain circumstances, ready to play it short, back to the previous swing low of the day. So we're ready to stop and reverse. What happens is that we get a standard re-entry pattern, which we call kata number 2, which is a continuation pattern consisting of an observable swing low, a higher low, and then it breaks through the dragon. And so now we're entitled to resume with a standard unit of risk. And then my job is to get that to no lose plus dinner for two. This becomes interesting to us if it's able to clear the previous peak of the RL10 and the PSAR. If it gets out to here, I'm entitled to think that this could be off to the races, and so I might think about a second position here. But until such time as it does that, I'm in the tactical trade space, and all our job is to do is to get our risk out and get to no lose plus dinner for two. So what we have is a set of very specific tools, simple trade framing, simple minimum indicators, and we have rehearsed this pattern hundreds of times, and we know how to trade it according to standard practice. And so last Thursday, the kata 2 really worked, and that thing turned into, on the second leg up, unsurprisingly, 1 unit of risk, 1, 2, 3, 4, 5, 6. You may remember that that was quite a move on Thursday. So we're now sitting at about plus 8 for the day. Another leg up for 3 more, so that's plus 11, and then 1 more plus 12. So that was about a 12-hour day on Thursday. And because we have no overnight risk, we didn't get trapped by Friday's move, which was an immediate collapse, and that put us into the posture to be ready for today's move. Now, today's move, just prior to the podcast here, we had this situation. So now I'm using 2-minute bars. And in this case, we had a large volatile move up, a gap. So we take the opening range. We saw the breakout. We take a standard entry long. We use our standard minimum manageable risk box. Right now, today, statistically, that's $1.25 in symbol SPY. So there's our risk box. And what that means is my next job is to get my stop here above my entry so that I can convert this into no lose plus dinner for 2 and turn this into a science project. If I can turn this into a science project, then my chimpanzee, my inner chimp, is not agitated, and I can trade this in a calm and relaxed manner. So with that trade frame, that standard work, we can then take a look at how did that trade unfold. Oh, I'm sorry. It turns out that worked like this. Standard exit at the edge of the dragon, which is our 10-period Bollinger Band. 10-period look back with a half a standard deviation. And this thing went as far as it went, and then we got our exit here. This pulls in 1R against a 1R risk in the usual way. And then a re-entry on the Kata 2, which is our continuation pattern. We have such a big gap up that we're not interested in going short until it breaks below the low of the day. So we have a low, a higher low, and a crossing of the dragon. So that gives us a standard entry long, standard risk box, and that one turns into another about half of an R win. Later in the morning, we get a standard, our second standard pattern, which is the supported spring crossing. We have a measured sell-off. The dragon rolls up. We see the PSAR violated. We get a standard long, standard risk, and then this one turns into, at this point, as we started, this was about 10 minutes before the workshop today, the decision I made at that point was where to put my stop. My stop was originally here. I was simply trailing the PSAR. I'm satisfied with that as a stop, which locks in about a 0.5 win. So I wonder where it's going to go, but I'm in a very calm zero state. It's just a science project. It's getting very close to a price level that if it gets above that, I'm interested. But if I just get 0.5, then I get 0.5. So that's an example of something that comes out of a true story circle, that comes out of the Creativity 202 course, and we simply use the tools that come out of the Foundations course in order to build the pieces and parts of a personally adapted system that makes sense to our folks. Then we use daily trading, coaching, and bar-by-bar exercises to really work through that. So I see we got about 10 minutes left to add a number of questions. The first one, let's see, where's the replay going to be located? They normally will send that out, and you can always contact me for a replay. Let's see, Salem asks, can I go over the risk box and how we base it? So there is the concept of the, and this is important too, that what we think of as the minimum manageable risk box The definition of it is important. It is the amount of risk that I can take, no matter what direction I'm going, so that I never take more. I'm sorry, that should be the other way. I never take more than a 1 hour loss. So that means I got to have some kind of signal built in. So if I was going to go long here because of reasons, because of a pattern or whatever your signal is, and then there is some price level that says this hypothesis is not true, there is some theory, there's some pattern which says if I get this entry, if I see this pattern over here, if I see a pattern and I get this entry criteria, there's a good reason to believe that thing will go. But there is always, from that moment of entry, there's always some price that disproves that hypothesis. That is the signal which says that hypothesis failed. So if that signal is what gets me out, that price gets me out, then how fast can I get out, and what's the slippage or the gap or whatever? What's the size of the box that I have to have so that my total loss is not greater than 1 R? Well, if I can do that, and if I never take more than a 1 R loss, then I am entitled to say that the MMRB that I came up with is legit, that I can use that as a standard planning factor. Then what I can do is I can take my standard planning factor of the MMRB and call that 1 R of execution risk, and then I want to make sure that en route to some reasonable price target, the same theory that says this is a good entry also says that this move up to this price level is reasonable. And if I can get a 2 or 3 to 1 compared to my risk, my reward to risk is favorable, and if I have a manageable stop, then I can see how many times a day or a week or a month can I get that, and now I can start building a good trading practice around that. Well, I say all that simply to say that depending on the time frame that you're in, how you build and select your MMRB is going to vary. If I'm a swing trader, I might start with something like 2 ATRs, because I might have gone back, maybe 2 years and studied the size of the gap and said that the biggest gap that I ever saw was maybe 1.5 ATR. Let's just say that that's what I want to protect against. So I might reasonably say, if I use 2 ATR, I will be able to get out without a 1 R loss. Well, if 2 ATR turns out to be my MMRB for swing trading, then what I have to be able to see is a reasonable justification for a 4 ATR risk, or a potential reward, to justify the reward to risk ratio. Now, if I'm not a swing trader, what if I am a monthly trader? Well, I might have to look at what is something like, what is the average loss plus 1 standard deviation, and say that's the largest reasonable loss I would ever take, and maybe that becomes my minimum manageable risk box. Well, can I see 2 of those as a justified upward move? If so, I can take the trade. Well, what if I'm an intraday trader? If I look at a 1-minute chart or a 3-minute chart or a 10-minute chart, whatever it may be, it may be that the intraday volatility and liquidity might drive me to find what the size of a manageable risk box is. Now, we have a particular set of strategies that lead us in sniper trading. In sniper trading, we take a statistical view, and we say, what is the maximum reasonable intraday move? We use statistics to define that, and then we simply take 1/10 of that, and we then see, is it possible that we can manage with 1/10 of that maximum reasonable intraday move? It turns out that we can. So we compute that daily. And what that means is if we saw a case where the price opened here and it sold off to a support level and started to move up, and maybe it crossed our little dragon, and then maybe we got some kind of entry right here, we would say that a risk box, a violation of the southern skin of the dragon or the bottom of price, that might be the minimum manageable risk box. And if so, we know that this thing could move. If that's one, this thing might move 9 boxes off that low before it becomes irrational exuberance. So it turns out that by using statistics in this way, we are able to develop a standard work for trade framing. We want to have standard work as professionals. And I want to do standard work in 2 conditions. Under normal conditions, what do I do? And second, under abnormal conditions. So no matter how I define those, I should have some way to determine this is a special case. And when I'm in a special case, I want to have rules for how I perform standard work so that I'm not trying to make it up on the fly. So the short answer to your question is that the MMRB, the minimum manageable risk box, is going to vary based on the kind of trading that you do and what you find as manageable, and it really relates to the time in between decisions. There was a question, does this require specific trading software? No. You can use these patterns on TradeStation and Ameritrade. It turns out, if I may put in a plug, that what we've done is we've taken all of the indicators that we use in our foundations course, and we've built out a TradeStation bundle that does all our scanning and filtering for intraday frames and swing trades, and gives you a execution support templates for intraday trading in a TradeStation bundle. And then we've also done that for TC2000. And 2 of my students, who are super traders, going through the Creativity 202 course, turned that into a Thinkorswim for Ameritrade, and they have a simplified rule set, which we call the Kata 2 challenge, and that is simply how to use that continuation pattern, how to find targets, how to trade targets, and they put that into a very concise trading plan, trading system, and trading workshop that has just become available. So we now have the patterns and indicators built for Thinkorswim, TradeStation, and for TC2000. But it turns out that any legitimate platform can be used to come up with the set of indicators that we use and the techniques that we follow. And we do a daily report for our subscribers, daily and weekend report, which gives you plenty of targets if you don't want to search for targets yourself. But those packages will also let you find those on your own. We do coaching every night for day traders and swing traders that are enrolled in the foundations course and the advanced patterns that we advanced workshops that we teach. And then on the weekends, on Saturday nights, like some of our swing traders that are senior traders post their trade frames, and those tend to be 20 to 30 charts that we review every Saturday night, which are good really for the whole week. And that makes us prepared for intraday trading or swing trading. Yes, it can also be replicated in TradingView because that's a reputable platform. And some of the good folks at our factory, who are my students, have also put together an introductory package. So they have done all the admin work for you. I just remembered that they have that together. So the R Factory people can do it in TradingView, and you'll find that these things will give you a structured, disciplined, professional approach to finding, framing, and trading our favored patterns. So I think that was everything I wanted to cover for today. And I would be happy to answer other questions that you guys may have if you will send them either to me or to Sarah in writing. What I do with all of the questions that come out of our students and all the workshops is I answer them in writing and with recordings, and I put that into the nightly strategy podcast, and we make that part of each course that we teach. So all of our courses include not just the instructional material, but also the call and response, the question and answers that come out of our students. And when you take a course with me, you get that course for life. There's no expiration on any of our courses. Now, I do notice we have a little bit of time left. Gary asks, can you give me, or can I give you my thoughts on break-even stops? If I made a 2R gain, should I move my stop to break even or let the play out, or should I let it go to 1R loss? Let me tell you that the most important lesson that we teach is the 2R battle drill. And this is the essence of it. We have some videos on that in the public domain, but here's what I'm going to tell you. If I set up a trade frame, and this is where I'm gonna, that's either the open or whatever, and I had some previous, maybe that was a daily bar, and I had some mechanical signal that said if this reverses and starts going up and it breaks through yesterday's high, that's a good entry. And that if it breaks below yesterday's low, that's a reason to get out of the trade. So what I'm doing is I'm using yesterday's risk, or yesterday's range, as my risk box. And let's say that a return to the 10-day high up here gives me 2 units of reward. And I'm not allowed to be surprised if it goes there because I have the statistics on that pattern which says it's not unusual for it to get to 2R. So I'm going to go back and I'm going to compute my average win. And let's say that my average win turned out to be 1R. So I'm framing for 2. My average win is 1. And my manageable risk box is 1. Now here's the situation. It opens here. It goes through my mechanical entry, so I get long. I take my 1R risk as I go. I'm not allowed to be surprised if it goes to 2 and then starts to fail. So now the question I put to you is, how much of that ideal 2R do you want to give back? Are you going to let it come back to 0? Knowing that your average win was 1? Never, never, ever. Under no circumstances do you let an above average win become a below average win. Under no circumstances do you let an above average win ever lose money. Never. And so the essence of the no lose plus dinner for 2 is I never move to break even. I go to no lose plus dinner for 2. So if it gets up to my average win, if it gets to my average win en route to a hoped for win, I'm going to make sure that my stop is at no lose plus dinner for 2 already. By the time I'm at an average win, I am never going to lose money on that trade. Unless it's a swing trade and it gaps against me outrageously, which is why I prefer intraday trading, to be honest. So my idea on break-even trade, if you're going to move to break-even, why not go to where you get a plus 100? So for me, my average risk per trade is $400. So if I can lock in a $100 gain, I just have a 0.25R in my favor. Start accumulating 0.25Rs. Start accumulating 0.25Rs and see what that does to your trading psychology. Once you can get your risk out and get to no lose plus dinner for 2, you can legitimately turn this into a science project. Now you have to know, how many times do I get to the 2R? How many times do I get to 1R? Where is my average trade? If it goes beyond 2R, how far does it go then? If it gets up into irrational exuberance, if it goes through 2R, should I be adding a second position? If so, How should I do that? If it fails and I take my little 0.25R here, I've turned a 2R trade into an above average win. That's very good for your psychology. So I want you to find the 2R battle drill, which is on YouTube under my name, Ken Long Tortoise, and you search for the 2R battle drill, and it's about 11 minutes. And you should listen to that every day for the next 30 days for free until you get sick and tired of the sound of my voice. That's the most important thing you can do to develop a professional mindset with respect to preserving gains and being ruthless on your risk management. If you ever got a 2R trade and you let that go negative, you know how bad that feels. Don't ever let that happen. In order to get into the mindset of managing your exits professionally, you have to have a stable set of rules so that you have a large set of trades to analyze so you can determine what is my average win, what is an above average win, when should I go to no lose plus dinner for two. All of those things are standard introductory practice towards managing your risk and managing your trades and your systems in a professional manner. So in conclusion, I don't believe in break-even trades. I believe in no lose plus dinner for two, because that little shift will fix your psychology. And then you must know your average win for every pattern, and you must know the histogram of the returns of a large data set so that we can start putting some math on it, because that's where you have an edge against people who will not do math. If you can do math and act on it, then you have a persistent edge for the rest of your life, or for as long as humans are trading the markets, which is forever. All right, so that's my short answer on that. Okay. I have us at 12:10, so I want to respect your time and say thanks. And if you will send other questions to me or to Sarah, then I'm happy to answer those in writing with a follow-up video, which she can distribute, or you can just listen in on our nightly podcast, which is open to you, the public, and you can listen to those free until you decide if being a client or on the team is good for you. So we're happy to extend that as a service. So all I would ask you to do is to be respectful of the folks that are in there getting their brains beat out every night with coaching, because they're paying good money to be coached, and I would ask you to just to respect their efforts and their courage. So that's everything I got, Sarah. Back over to you.
I think you ended that nicely. As Ken said, anything that you need from us, feel free to reach out to customer service. Thanks, Ken, for your presentation, and everyone, thank you for participating. We hope to see you next week.